Hi there. Thanks for joining us today. I'm here with Aaron Arnold and Will Granleys from Antrim Investments. We're lucky to have Will with us today on November 26, 2020. We thought we would do one of our first webinars with the Antrim Balanced Mortgage Fund, an alternative investment we've held in client portfolios now for a number of years. So we're really happy and thankful for you to take the time today, Will. And look forward to hearing what you have to say to our clients. And hopefully this is an informative session for everybody, so you can get to know a little bit more about some of the alternative investments that we hold in the portfolios.
Perfect. Yeah, really appreciate it. And Robert and Aaron, hope yourselves and your family are keeping well in these trying times. I know we all have to embrace technology, and I think we're doing a pretty good job of it here today. We should be able to get our point across and everybody stays safe, which is great. I'm going to take control of the screens to be presented here, if you're all right with that.
Perfect.
Just let me know if you can see my screen now. Can you see that?
We can, sir.
Yeah, we're good.
Okay. So we'll start here just very briefly here. This presentation has been produced by Antrim Investments. It's a presentation that we generally give to advisors and their clients. Any particular questions, though, that you as an investor might have, please do reach out to Robert and Aaron and ask questions. Alternative investments are not necessarily suitable for all clients, and Robert and Aaron will be happy to talk to you and make sure if Antrim is something for your portfolio. So we just had to have that disclaimer there. Next, we'll go over a little bit about the presentation that we have here today. Antrim is being used in many of your portfolios as a fixed income solution. I don't know if anyone's gone down to the bank over the last couple of days and taken a look at what term deposits and government bonds are paying, but it's pretty low, maybe 0.5% or 0.75% if you're lucky. With Antrim, we're still predicting that return in the 5.5% to 6.5% range, which is great, considering the pandemic that we're going through and the level of security that we're offering. So we're going through the investment. We'll talk a little bit about what we're watching and what we're looking for, and then we'll get into a period of questions. So to start out with here, for those who don't know about us, Antrim is actually Canada's largest residential mortgage investment corporation. We've been in the business for over 50 years and have over 1,700 mortgages in our pool. So you can think of us almost like a credit union or a private bank. The key features and why Luft Financial has added Antrim to your portfolios is primarily because of the no net asset value fluctuation. You've probably noticed during the pandemic, if you've been watching your financial statements, that Antrim's value has stayed stable, always at $1 par. It hasn't been going up or going down. This is excellent from a diversification standpoint because it really maintains the safety in the portfolio and really reduces the volatility from certain events. Additionally to that, we're paying that 5 to 7% yield, which is great. And we offer a lot of liquidity as well. So if you ever need to make a redemption for some reason, we can offer you those funds in as little as 2 days. So that's a little bit about the fund itself. Some of you might be saying, well, how does a mortgage fund pay 6 or 7%? How is this even possible? Well, this is what we do. We offer first and second mortgages with 1-year terms only on them, on residential properties in major centers of Canada, primarily to self-employed individuals, okay? Self-employed individuals, which you'll see here, is our main borrowing class and take up about 80% of the portfolio. These are individuals that make a great income, but unfortunately they write off their expenses as much as possible. They may split their income with a business partner or maybe a spouse. And at the end of the day, what they end up finding is that they don't quite make the income that's required for a bank mortgage. Now, we are happy to provide them with a mortgage for a couple of years until they become bankable again, because we can look past the simple write-offs and the fact that they're showing a lower income. So that's the majority of our borrowers. We deal with some other people as well, maybe new immigrants to Canada. I'm not sure if everybody on the call realizes that the federal government target for new immigrants in Canada is 450,000 new immigrants a year. The federal Liberal Party is looking at bringing in approximately 1% of Canada's population, new immigration on an annual basis. And that equates to about 450,000 a year, or about 1.2 million over the next 3 years. So that's what they're looking at. Further to that, a little bit more about our borrowers. Our borrowers, like we said, are self-employed typically, but they also tend to fall within the age range of about 45 to 65 years old, okay? They're self-employed, they've owned real estate for 10 years or more, and they have substantial equity in their property. It's just that for one reason or another, typically due to debt servicing, they can't be approved for a bank mortgage. They have great credit. It's just like I said, they can't be approved for a bank mortgage. So those are the type of people that we look after. The majority of our mortgages are first mortgages. So about 75 to 80% of our mortgages are first mortgages, and about the remaining, say, 20% are second mortgages. That's sort of the asset allocation in the portfolio as it stands right now. The amount of the Canadian mortgage market here that we participate in is about sort of 2%. So our business is about 2% of the Canadian mortgage market. Sounds like a small number, and it is, but when you consider the Canadian mortgage market is $1.3 trillion in size, you're still dealing with tens of billions of dollars in industry. This graph here, if you take a look at it, actually shows that about 74 or 75% of all mortgages in Canada are taken up by the major banks, with about another 12.5%, say, taken up by credit unions. The rest, where we fall into, made up of trust companies, private lenders like ourselves and others. So that's giving you an idea of what it is that we do and the marketplace that we operate in. What's been happening to our industry over the last number of years? Well, it's always been a growing industry. Antrim's been in business now for almost 50 years. And in the 70s and 80s and 90s, there was always more and more business, but it really started to accelerate after the financial crisis of 08-09. After 08-09, many of you will remember that the federal government came along and really tried to tighten the screws on mortgage approvals because they saw housing prices go up high. When they did that, they made it harder to get a bank mortgage, and that basically pushed more people into using credit unions, trust companies, and people like Antrim, alternative lenders. So that's really what's been happening, which is great news for us here over the last number of years. I'll give you an example actually now. I'll give you an example of the type of mortgage that we do. This picture here is a picture of a downtown condo. In this particular case, the family was buying this condo for $780,000. They required a first mortgage for $429,000, which was 55% of the appraised value. The interest rate we wanted to charge them was 6.95%. Again, that's 6.95. And the reason why they weren't approved by the banks was simply because the husband, the father, actually was working overseas in Korea as a university professor. And because he was earning his income overseas, the major banks couldn't qualify his application. So that was an easy piece for us. So we knew the family's plan was in a couple of years that the father was going to start working in Canada and start earning Canadian income and would qualify at that point in time. So it's sort of a good example of the type of mortgage we do. This family is most likely just going to be an Antrim borrower for a couple of years, and then they'll migrate back to prime rates. It's a good example. Robert, Aaron, do you have any questions up to this point? I'm just doing all the talking here. Are you guys good?
I'm just enthralled with your presentation. No, Will. I mean, one of the questions we do get a lot is why, I think that's one of the ones, Aaron, you're going to bring up too, is why people deal with you.
Why do people deal with us? Well, we're in the business of solutions, right? Whenever we talk to our clients, we're always talking about being able to put them in a position that they're better off once they get an Antrim mortgage. They can do a debt consolidation. They can purchase that house now as opposed to waiting. That example we just talked about with that family where the husband was working in Korea, I mean, sure, they could go ahead and just rent a unit for the next couple of years, but the family wants the pride of ownership. They want to be able to build equity in Canada. They want to be able to build credit in Canada. So what a great thing that that Antrim can offer them and help them get a foothold in Canada, and works great for our investors. Our investors earn a 6% rate of return with the low loan to value, the low percentage of our loan to the housing price is a very, very safe investment for our shareholders. So it works for everyone.
Mm-hmm. Do you guys or do the banks classify these borrowers as higher risk?
Well, technically, yes. The bank would consider these people a higher risk because they're not lending to them. The banks actually have federal guidelines that they have to go by. And one of the main guidelines is debt servicing, this thing I keep talking about. And what that means is it's a ratio as to how much your mortgage payments are as to how much your income is. And if your mortgage payments become a higher and higher percentage of your income, then they think that's risky and they don't want to lend it to you. The problem is new immigrants coming to Canada don't have income documents. They haven't made income here, so they can't show anything. And like I discussed with self-employed individuals, they write off a lot of things. They split income with their spouse or their partner, and they're in the same problem. They might make a great income, but on paper, it doesn't show it. So, so that's my answer to that. All right.
Yeah.
Okay. So this talks a little bit about what happened to COVID-19. Everyone's saying, what happened with you guys in COVID-19 in the banking industry? And this graph here shows during the height of the pandemic for what was that first wave, March, April, May, when everyone just really was brand new news to us. Coming into that, our borrowers were playing very well. As you can see here, only about 2% of our borrowers were ever experiencing any delinquency or any issues. As the pandemic grew on, we started seeing more and more to a period where we actually had about 9% of our borrowers requesting a formal deferral. Now, the deferral meaning, hey, I don't want to make payments for a couple of months because I've lost my job or what have you. Some people listening will recognize that the major banks actually offered this program as well for a full 6 months. We told our borrowers we're not governed by the same rules as the banks, but you know what? We're in a great position here. We're happy to give you 2 months of no payments if you need it. And many people took us up on that, like I say, up to 9%. But what we noticed after the pandemic was absolutely unbelievable. That's when the government stimulus started hitting. The CERB, the CERB payment, the wage subsidy, the rent subsidies, everything started hitting the market, and there was just a wash of liquidity, a wash of cash in the market, and we saw most of these borrowers phone us back up and say, you know what, thank you very much for letting me take a month or two off my mortgage, but I don't need it anymore. I got all the money I need, and I can start making these payments now. So we started seeing this en masse in May and June, and to my delight, I'm happy to tell everyone that's watching this right now, and Rob and Aaron have already got this information because they talk to me on a regular basis, but they know that the deferral rate right now is the lowest we have had in 30 years. It's absolutely incredible. So of the 1,700 mortgages that we have right now, only 20 of those mortgages are experiencing looking for a payment deferral or a payment delay. So all this money that's in the system that you see right now has gone a tremendous way to help anyone in our business, in the banking business with mortgage foreclosures, which is great for shareholders. Running into this COVID-19, on the security side, we were all wondering what is going to happen to housing prices. We didn't know, right? And so what we decided to do was look to the past and what had happened in the past. And if we look at the recession of 1980-81, this is, if you were around for it, this is when interest rates went up to 19-20% for a one-year term. We looked at the financial crisis of 2008, 2009, and also the recession of the early 1990s. And in all three of those cases, what we found is that housing activity tended to lull, but then go back to normal in about 18 months. So that was sort of the key. About 18 months we thought we were going to be in this for, as far as housing prices go. We figured that would be exactly the same thing. The only difference with COVID-19, we thought, was that what would end up happening, if you see this yellow line here, we thought that maybe sales during COVID-19 would drop off just a little bit faster because, you're sheltering in place and you can't show your house for a open house, and it's going to be more difficult. So we thought it'd be still 18 months, but close down faster. This is actually what happened. What actually happened is, as we predicted initially, housing, the number of sales dropped off very quickly. But no one was expecting this dramatic V-shaped recovery that we saw. And the housing market roaring back within about 60 to 90 days of the start of the pandemic, roaring back so fast that the number of sales on residential housing actually surpassing the number of sales pre-COVID-19. And this was not just in British Columbia. This is a graph here of Canada. You can see here the dark line is the number of sales going on. You can see a big drop of number of sales COVID and a spike back right up here. And you can see where we are right now. There's dramatically more real estate transactions that are going on right now than what's happening before COVID. Now, what all this is doing is this is creating a tremendous amount of buying pressure. Okay, there's not a lot of real estate for sale out there, and there's lots of buyers. And if you follow any real estate marketing literature, you'll be familiar with a graph like this, which is basically showing you, is there a lot of supply pressure or demand pressure in the market? And this graph clearly shows by province in the country how much pressure there is on the supply side. There's simply, for every 10 houses that are coming up for sale, they're all being bought up on a monthly basis, and it's really pushing for a seller's market right across the country. If we look at this graph, for example, this is outside Toronto sales. What they mean here is suburban Toronto sales. You can see steadily here, starting in 2012, more and more and more and more and more pressure to a point right now where going back to when this graph was produced, we've never seen as much demand, a big supply and demand imbalance as we're seeing in those markets. And that's leading to price increases. If you follow the news, you've probably seen that since the pandemic has started, prices in the Greater Toronto area have gone up by about 10 to 12%, and prices in the Greater Vancouver area have gone up by about 8 to 10% as well. So that's just where you're really seeing these things come out. Another very interesting graph was produced here. This is done by National Bank Financial. They came out with this report about 3 weeks ago. And so explain what you're seeing here. The green line is the city of Montreal, the red line is the city of Vancouver, and the blue line is the city of Toronto. And this is showing labor force and labor force participation. What you'll notice is that when the pandemic hit, a lot of jobs were lost, okay? But then as the pandemic went by, and as we were in the middle of the pandemic, I guess, still, you can see dramatically how these jobs came back. And in Toronto, for example, there's actually more jobs right now in Toronto than there was pre-pandemic. And in Montreal, there's more jobs than there was pre-pandemic. Vancouver's almost back to where we were. The point here being that in the major centers of Canada where we do our lending, we don't lend in Montreal, for example, but in Toronto and Vancouver, you're seeing people have work, right? They have work, there's very low interest rates, and there's very little supply of housing available. And that's kind of the theme of why you're seeing housing prices increase so much. So if we look at condos as opposed to detached housing or other dwelling, we notice that there's a bit of a disconnect on the condo market. Condo prices are a little bit softer right now. I'm going to put Rob and Aaron on the hot seat here. Guys, how many foreign students do you think live in Greater Vancouver? Just
Greater Vancouver or Canada?
Greater Vancouver only, Greater Vancouver.
Like currently or pre-COVID?
Pre-COVID.
I'm going to say upwards of 50,000.
Oh, that's a very good guess. It's a very good guess. Very good guess. It's around 60,000 in Vancouver.
Yeah. Wasn't a guess.
That was a very, very good. And over 120,000 in Greater Toronto. So what do you think happens when the majority of these people, let's say, are coming from China or overseas, when they're not allowed to come to Canada during a pandemic? They stay at home, right? And many of those students lived in condos downtown or basement suites. And what we're seeing is owners of condos are having a very difficult time renting a place. The other issue here is that there's no Airbnb business. There's no vacation rentalers. There's no there's no vacationers right now. So all these people would be utilizing, condo real estate, and because they're not here right now, it's having a dramatic effect on the condo market. So much so that in the Vancouver area, where we are here, in the Vancouver area, we see that rental rates on condos are down by as much as 15% in the downtown core, which is unheard of in our area. I mean, for 30 years, we've never seen anything like that. So our opinion in our office is this is relatively short-term in duration. As soon as we get past the worst here of COVID-19, we start seeing foreign students coming back, we start seeing borders opening and vacation rentals being able to open up, you'll start seeing the condo market recover. But for the next 6 months, you're probably going to see a relatively quiet condo market, but a white-hot other market as we've described.
Will, one of the things you commented before, just for our listeners, 1,700 approximately outstanding mortgages. You might have answered this before, but what percentage of those outstanding mortgages would be on residential condos versus residential detached?
Okay, yeah, good question. So we have about 80% of our portfolio is on residential detached houses. Think about white picket fence and a nice backyard. Yep. And about 20% in condos.
And just again for our listeners, the fascination with the prices would be from Antrim's standpoint as a lender, because your majority of what you're lending on is loan to value. In other words, if you've got a person with $1 million condo and you have lent that person $500,000, it's in your best interest that that condo does not depreciate, so that you can secure the level of financing against that asset as collateral, correct?
That's correct.
Right.
So I would assume that most people that are watching this particular webinar, many of them would be Antrim investors. And what they need to realize is that if a house, let's say, is worth $400,000 and we lend $300,000 against it, it's in all of our best interest for that house to become more and more valuable. As that house becomes more and more valuable, the amount of equity, the amount of security that we have in that property increases, right? It's concerning to us as portfolio managers if we see the real estate market decreasing substantially, because it just means that market price is coming closer and closer to our loan value. Now, a point of comfort I think that all Antrim investors should take is not only that our average loan right now is only 60% advanced generally, on average, according to the property. We have not had one single year with a negative rate of return. And it's our investment philosophy to not hit home runs, hit base hits, earn that 5, 6, 7% nice and steady, not take a lot of risks, and that's how we do it. So yes, you're 100%. That's why I talk about real estate prices. That's why it's so important to us, because it affects all of our security. Other things. So just as a recap, what's driving these real estate prices? Because I'm sure everyone just can't believe that these real estate prices are going up in the middle of the pandemic. Historically low interest rates. You can go to your bank right now and get a 5-year fixed mortgage for 1.8, 1.9%. You have strong job markets in these centers where we're lending. Essentially a fixed supply of real estate. What we mean by that is that it takes a long time to build a house. It takes maybe 3 months to get a permit. It then takes another year to actually build the house. So in the short term, over the next couple of months, there's not going to be any new houses or any new condos coming onto the marketplace. It's a fixed supply, which if you have a lot of demand, helps to increase prices. A tremendous amount of government stimulus going on right now. The government has said that they're going to extend the CERB, which is now being administered by the EI platform, for another 24 weeks, which is approximately 6 months. We are going to see a wash of cash in the economy for another 6 months. After that, from what we hear from Ottawa, they'll continue to do it if we need it even longer than that. But we're watching that. The immigration piece is absolutely huge. We talked about that a little earlier in the presentation, that the federal government is targeting 450,000 new immigrants a year into Canada. Now, guess which 3 cities most immigrants want to go to? Vancouver, Toronto, and Montreal. Some may go to Edmonton, some may go to Calgary, but suffice to say, they're not going to Prince George, they're not going to small prairie towns or small town Ontario. They're going to these major centers. And it's putting a tremendous amount of pressure on our centers. To bring it home here, Surrey alone next year is expecting 10,000 new immigrants just to go into the municipality of Surrey. That puts a tremendous amount of pressure on the supply of houses. Many of the people coming to Canada have been successful overseas. They have wealth, and they're able to compete easily with the local income. So that's what we're seeing. What we're watching, what we're at our office, what we're watching for when we're looking at the portfolio is we're watching that federal immigration policy. We're just making sure that everything is staying the same. If it is, we can expect further pressure on housing prices. When will the borders open again? When the borders open again, you'll notice that'll be very good for the condo market. The government stimulus, how much longer will this be going on for? We're watching the bank deferral performance and what they're seeing. Recently, in the last week or so, HSBC just announced that they are reducing their loan loss reserves. So things are better than they expected. About 3 weeks ago, Scotiabank came out and they said the same thing. Yeah, you know what? This is not affecting us as much as we thought. So we're watching to see that the banks are performing and seeing the same thing as ourselves. A couple of interesting things to note that maybe not everyone knows is that during this pandemic, the balances on Canadian line of credit and Visa cards, MasterCards, credit cards has actually reduced. Okay, people are not living off their credit cards as maybe we're being told or we thought. The statistics actually show that credit card balances are decreasing. The statistics show us that of the G7 nations, Canada is one of the only ones that's shown an increase in the average wage during COVID-19. Again, all of this government stimulus that's going out. So, so this is all obviously being very good for anyone in the lending business. You guys have any more questions? I've just been rolling through there for a little while. Anything that pops up?
Keep going for now. We'll do some more questions at the end.
We're good. Okay. Now, just as further sort of clarity about the rates that we charge, on this screen here shows you the current rates we're charging our borrowers. If someone is looking for a 60% of the value of the property that they're buying, we'll charge them 5.95%. Now, it's a one-year term and it's fully open, which means they can pay us back whenever they want, no penalty. Okay. And again, the borrowers are coming to us for a short term. They're coming to us for typically 1 to 3 years until they can refinance at a bank. Now, if they're looking for 75% of the value of the property, we consider that a slightly more aggressive loan, more risky loan, and so we want to charge them 6.95%. Second mortgage rates, you can see here anywhere from about 8 to 10% that we're charging. First mortgage rates, just as a historical aside, have gone down by about 0.5% over the past 6 months. And
Will, just a little bit more on the on those rates. Sure. Now, people always compare, your rate to a 5-year fixed rate, which is, as you mentioned before, is 1.8, 1.9%, something like that right now. But how do those compare to, comparing apples to apples to a 1-year open rate at a bank?
Right. So apples to apples, a 1-year open rate, you can see we're clearly much higher than the banks. But what investors have to think about is the source of funds. The major banks in Canada can basically borrow from the federal government and even get those mortgages fully insured by the federal government at next to nothing. They can borrow the money for literally next to nothing. Ourselves, so their opportunity cost is very little. At Antrim, what we have to do, we can only lend out funds if we have deposits to do so. So when an investor, let's say, makes a $10,000 or $100,000 deposit in Antrim, we then have the ability to lend that out. So what we have to do, because we're not federally insured like the banks, is we have to show a risk premium. We have to show that we pay the investors a higher amount, or else the investors wouldn't decide to invest with Antrim. Antrim probably wouldn't be part of your portfolios if we were only paying a 3% rate. So on a daily basis, we are dealing with investors and we're dealing with borrowers and trying to find that equilibrium where everyone is happy. And in our marketplace right now, these are the rates that we're seeing. They are going down slightly as all interest rates in the marketplace are going down. and that's to be expected. Probably, I would say the rate of return over the next year might be going down by as much as 25 basis points, so that's 1/4%. Not a very big deal, but it is different from what's been happening over the last couple of years, and that's all. It's all again, it's marketplace determined. Does that make sense, Aaron?
Yeah.
Okay. So moving off of that, we can show our average rates where we were. I've already spoken about the security in the portfolio right now. It's exceptional. Everything is basically paying as agreed. And if you take a look at our loan losses here over the last number of years, we've been experiencing lower and lower loan losses on an annual basis. And that's to be expected here going forward. The federal government has basically said that they're not touching interest rates. They're leaving them as low as possible. And the stimulus is on. So we should be very favorable in that regard. The next thing I want to talk about briefly is just what to expect here as far as rates of return go. When you're dealing with Luft Financial, when you're dealing with Robert and Aaron, you actually purchase an institutional class of our funds, which produces a relatively high payout. So last year we paid 7.01% on those shares that you had with Antrim. What we're expecting this next year, like I just said, is that losses and expenses will be very similar, except the actual rate that we're charging to borrowers will go down a little bit. So maybe expect our rate of return to be maybe 6 3/4%, something like that, as opposed to 7%. Our guiding principle is to make sure that your principal is secure. That's the first thing we look after. Once that's done, then we look to get the best rate possible. And in order to keep everything nice and safe, it looks like we're going to have to forego just a little bit of interest over the next year or two. But again, I bring you back to this graph showing our historical performance in all markets, showing that, again, we haven't had a principal loss in 25 years. This is a graph that maybe your portfolio managers will be looking at. It shows this risk premium I'm talking about. This red graph here is Government of Canada bonds, and these graphs are Antrim's performance. And you can see year after year, Antrim always has a nice risk premium to what the government is doing. But in general, Antrim also follows the trend. So the trend into 2020-21 is that interest rates are going to be falling slightly. So you're going to see, again, us maintain a nice, healthy risk premium, but you're going to notice that that our rates will be dropping slightly as well. I'm just going to go over a couple of slides that are maybe a little bit more technical in nature, and we don't need to talk about those today. That's basically the majority of my presentation. I would welcome anyone watching the show to go onto our website, antriminvestments.com. I know that Robert and Aaron provide you with information on Antrim, but there's also, if you want, there's also information on our advisor site, and you can take a look at that, and you might be interested in that. So what do you think there? Maybe I'll reduce the screen here so we can see us all again, and have some questions. How about that? Sure.
Sometimes we get questions about from our clients, and it's good to kind of walk through the process of what would happen when one of your borrowers does default on the loan. What is your process there, and typically how has that resulted for you?
Mm-hmm. So the important thing for everyone to understand is that there's no difference between Antrim and, let's say, the Royal Bank or TD Bank when it comes to foreclosures. It's identical. And not only that, but we don't want foreclosures, or it's an administrative problem. It's just things we try to avoid. But when it comes to a foreclosure, typically what ends up happening is the client has stopped paying for one reason or another. We will then go to the courts and we will say, listen, Mr. and Mrs. Smith haven't been making their payments, and we would like to collect our loan back. Please, judge or master, please provide us the option to sell their home, and so we can get our mortgage back. And then the judge will typically look at the borrowers and say, well, is this true? You haven't been paying Antrim? And they'll say, okay. The judge will look at the file, and the judge will say, well, Antrim, you're not going to lose anything here. Look, you've got a lot of equity. Why don't I provide the borrowers 6 months to typically sort themselves out? and see what they can do. And Antrim, if the borrowers have not sorted themselves out in 6 months, then you can come back into court and I will grant you the right to sell their property. So most of the time, borrowers don't sort themselves out for whatever reason. We go back into court 6 months later. The mortgage is still accruing. There's no loss of interest or anything. The mortgage is still accruing. We get the right to sell the property. We hire a realtor. The property is sold in a couple of months, and then when the property is sold, our mortgage gets paid back first, and then all of the balance gets paid to the homeowner. So that's typically that's how it works.
So going back to that loan to value of why that's so important and the raising equity prices or housing prices, the equity in the house.
That's why I like to focus so much on what's happening on the residential real estate market, because it is so important from a security standpoint. And like I said a couple times in today's meeting, security is number one for us. That is, the yield and the rate of return is number two for Antrim. Security is number one. So if we're in a marketplace right now with rising real estate prices, this just makes our investment that much safer for everybody.
And on the more positive side to end, a typical loan mortgage, you mentioned it usually only lasts a couple of years, or what's the usual process for when it all goes to plan?
Well, it's really interesting because many borrowers will come to Antrim only needing the funds for a couple of months. An example of that would be a person, let's say, buying a condo downtown and they want to flip it for one reason, right? The bank, for some reason, may not approve the mortgage, but Antrim will do it. They can have our mortgage for a couple of months, and then they sell it and they're on their way. But typically, when it's a self-employed individual or a new immigrant, they'll typically need our mortgage for about 3 years until they can either requalify their income or until they can just meet the bank's lending guidelines. And the vast majority of our clients, I would say probably 80% of our borrowers get refinanced to a bank. The other 20% either sell the mortgage or pay us off or what have you. But that's typically the life cycle of our mortgages.
That's good. One of the things for the clients watching to really understand is why do we hold this? So the idea of having alternatives, just to reiterate, is that it's an alternative usually to the traditional asset classes being fixed income, cash, and equities or stocks. So, you talk about capital preservation being paramount. And one of the reasons a long time ago that we looked to add Antrim was to look at capital preservation on the fixed income side of our portfolio. Now, that doesn't sound like it's intuitive to a lot of people listening. That's why you buy bonds, is to preserve the capital. But let me play devil's advocate to you here, Will. And I've done this with you many times over the years. In the alternative universe where we get a rising yield environment and we get pressure on the 5-year Government of Canada bond rates, which is, just to remind people, where 5-year fixed mortgages are set. So the bond market gets pressure. We have an improving economy and interest rates rise. How does this affect Antrim as far as positively or negatively versus how it might affect the bond market? So just to remind people that might not have taken Bond 101, in a rising yield environment, when yield pressure occurs and interest rates are rising, especially in the bond market, the price of the existing bond that you hold goes down. So we're at historically low yields. And people can talk about those yields being compressed and staying low for long, but at some point in time, this money has to be paid back, and people will demand higher rates, which means we could see negative downward pressure in the bond market on prices. In other words, capital losses on your bonds. So speak to, Will, why. I know you know the answer, and I know the answer, and Aaron knows the answer, but what happens to Antrim in a rising yield environment?
Right. Yeah. Good question, Robert. So everyone needs to remember here again that Antrim provides 1-year mortgage terms. Okay. What this means is that every year we get to readjust the rate to whatever the prevailing market rate is. Okay. So as Robert is suggesting, in the future, interest rates will need to rise because, hey, can't go any lower from where they are right now. He's also rightly outlined the inverse relationship that there is between yield and price on typical bonds. With Antrim, as interest rates rise, we simply increase the interest rate on our mortgages upon renewal. So you don't have that inverse relationship. You'll still experience that, that steady net asset value. The par value will stay the same, but your interest that you're earning on an annual basis will actually increase as interest rates rise. So a slow and steady rising interest rate market is a very nice market for us. We have no concerns with that market. Whereas, as Robert and Aaron point out, a rising interest rate market is a very dangerous market for traditional fixed income.
Yeah, and this is why we've made an allocation in your portfolios and our portfolios that we manage to something like Antrim to protect our clients on the downside for what we believe is an inevitable rise in the 5 to 10 year yields on traditional government and corporate bonds.
Yeah.
So you provide a really great level of capital safety as well as the cash flows that we require for those clients, especially in retirement. So you guys keep doing a great job. Any more questions from us, Aaron, you think?
No, I think that's about a good amount of time.
Good.
Great. Thanks for taking the time to talk with us today, Will. It's always informative, and we really appreciate you and what your team does over there at Antrim.
Yeah, thanks for having me. Thank you.
Okay. Take care. Have a great day.